Darius just mentioned the pivot, global growth versus inflation. I think there's so many ways to go with this. I think one of the biggest things, maybe Darius, you could elaborate on, is how the inflation regime may have changed it and its structural implications for the other asset prices. Like, I actually think that at the highest level is something that's kind of misunderstood.
Mm-hmm.
The reason that you're getting correlations between fixed income and growth assets now, and that's quite unique. Like you have to go back to sort of pre-1990 to get bonds and stocks correlating. So we've got this combined drawdown in these two asset classes that for 30 years have been very non-correlated.
Yeah.
And maybe you could touch on a little bit of, the inflationary dynamics and how it sort of causes that structurally.
Yep.
And
100%.
then and help people sort of understand that this is truly a regime change. It's different. It's not by the fucking dip anymore. Like, this is a slightly different set of circumstances. You have to be careful with the BTFD crowd now.
Yeah.
Right? I don't know. We're trying to help. Right?
Yeah, absolutely. So one of my favorite jokes, Ani, if you can pull up our my slide deck here, sort of one of my favorite jokes before I even get into the inflation is, we swapped girlfriends here year to date. So we went from like dating our friend Tina.
Yeah.
She was all the rage. She was the hot girl on the block, and now we have to dump Tina, and now there's Tara, and there's a reasonable alternative to there is no alternative, and that reasonable alternative now is cash, the yield that we're seeing on cash. So this chart shows is the blue line is the sort of the 12-month T-bill yield at sort of, I think, where we at here, most recent price at 4.47%. We got the S&P 500's next 12-month dividend yield, and as you can see, we're now 268 basis points north of that. I mean, you have to go back to when I was in, I want to say sixth grade maybe or something like that. No, I think I was in eighth grade the last time we had T-bill yields significantly higher than S&P yield. So there is a reasonable alternative, and part of the reason there's a reasonable alternative is the Fed's response to inflation. You asked a question about regime change and why stocks and bonds are now correlated. After spending most of the previous 30 years, inversely correlated and really being the foundational aspects of 60-40, risk parity, et cetera. And the real driver of that is, there's a couple of things. One, we're in a higher inflation regime. And, we can talk about all the different drivers of the inflation regime separately, but, just kind of the key takeaways on this transition, this regime change is, higher inflation tends to beget higher inflation volatility. The blue line in this chart just shows headline CPI data going all the way back to 1881 from my former professor at Yale University here, Bob Chiller. And, what you tend to see is high inflation regimes tend to correspond to higher levels of inflation volatility. This is this red line shows the percentile of the trailing 5-year volatility, realized volatility of headline CPI. And so when you look at that further, you tend to want you can sort of explore the data in several different sort of categories. But one thing we looked at and did the research on is try to understand, hey, what does the higher inflation volatility means? Well, we typically see higher volatility in both nominal and real economic growth. What we're showing here in this chart, as a proxy for both nominal and real growth, are just the mean percentiles of the 5-year volatility of nominal earnings growth and real earnings growth on the right. And as you can see, it's a pretty linear step function increase higher if you go from the first quartile to the fourth quartile in inflation volatility in terms of the relationship to earnings volatility. And so part of the reason, good to kind of land the bow on the plane or land the plane on the tarmac here. Part of the reason we're seeing so much volatility in fixed income markets because we're transitioning from something that looks like this, from an economic standpoint, a nominal growth standpoint, a real growth standpoint, the two most important variables for pricing fixed income securities, to something that looks more like this, in terms of the kind of volatility we're going to see with inflation and growth. And so ultimately, the bond market is having a really difficult time. This is 10-year Treasury term premium. The bond market's having a difficult time trying to ascertain, one, what is the fundamental price of a fixed income security in this different regime where we're probably going to have more structural inflation. And I also happen to think, which is a loaded statement, we can unpack this later, I also happen to think we're going to have the Fed acquiesce to more structural inflation at some point later in the next couple of years. And so as a function of that, there's all this sort of consternation going on across global sovereign debt markets associated with repricing all that different volatility and the changes in the Fed's reaction function of that, but also consternation associated with just a general uncertainty. That those are kind of big things there.